Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and in this episode, we're talking about recent bank M&A activity, or the lack thereof, valuations in the space, how the interest rate environment and economic uncertainty has impacted transactions, as well as how regulation has impacted deals, the approval process, and what the outlook is like going forward. We recently moderated a webinar that addressed those issues and featured some of the most active deal advisors in bankland. On the panel was Scott Anderson, Global Head of Investment Banking at Keefe, Bruyette & Woods, Mitch Eitel, Managing Partner in the Financial Services Group at Sullivan Cromwell, Mark Minting, Partner at Sullivan Cromwell, and David Sandler, Co-Head of the Financial Services Investment Banking Group at Piper Sandler. We kicked off the discussion by noting that deal activity had dropped significantly through the first 9 months of 2022. We had just 128 bank deals servicing during that period, which is down from about 166 a year ago. The year-over-year decline in deal value was even more pronounced, though, falling more than 60%, as just two $500 million plus transactions had surfaced this year. We wanted to know and began by asking KBW's Scott Anderson why we've seen such a large drop-off in deals.
You hit the nail on the head. The small deal activity is not so bad. It's that we're not seeing many of the larger deals. And you got to get some perspective on what we saw last year versus kind of what we've seen historically. Last year was huge. We had $77 billion in activity. It was the most active deal going back to 2006. So we had a tremendous amount of activity. It's tough to compare against that activity. And then when you think about it, all those companies that were involved in those deals are now digesting. And so we did a lot, and then they needed to rest a bit and get those deals executed. Then you layer on top of that, the economy, of course, is more tenuous than it was a year ago. We've seen inflation spike and rates spike, and the economy is a bit more of a question mark, and credit's now in the realm of conversation. And then all the while, the regulatory environment became very murky. So you kind of had a perfect storm of what was logically going to be a slowdown in activity.
As Scott noted, one huge area of concern is regulation. Mitch Eitel from Sullivan Cromwell said that many of his firm's clients are worried about getting deals past the regulators, not just even concerned about the length of time it would require them to gain approval.
I think there are a lot of factors, right? Economic factors always weigh on people's minds, and Scott addressed some of those. So economic uncertainty and certainty in the regulatory environment, are both elements of that. With respect to the regulatory environment, you've seen a fair amount of question about, can I get deals done in today's world, because it's taken so long to get, particularly the larger transactions, through the process. Not only the larger, but transactions in the middle range of things have also taken a longer time than I think people had come to expect. If you have a deal that doesn't require going to Washington, it's small enough to get done quickly. I think people understand that those can still get done very quickly. I'm hopeful that the approval of the MUFG U.S. Bank deal that just came out from the Fed will help to readjust people's expectations.
Mitch further noted that the regulatory environment has been a factor impacting many deals. And before we had him unpack that issue further, we then asked if the fears of regulatory scrutiny and other financial challenges were actually even preventing many deal discussions from continuing. David Sandler said that deal discussions had continued apace. That wasn't the issue, though. The issue really lied in execution.
They are, and as you know, we had a pre-call where you threw out the concept that maybe this is buyer and seller expectations not meeting, and Scott and I kind of laughed and said price is not in the top 3 reasons that are getting away right now. I mean, there's a tremendous amount of desire in a world where banks are looking at earnings, notwithstanding this quarter, and we can talk about that, but where earnings and earnings growth aren't necessarily out there in a big way. The ability to compound earnings growth, or at least add earnings growth and accrete earnings by putting 2 companies together, is pretty compelling. And most, call them buyers and sellers, see that. So there's no lack of desire to have the conversation. But I'll tie three things together. The first is what Mitch and Mark are talking about. If you look at the average approval time and the hurdle to keep approval in the region as opposed to DC, these are things that have extended dramatically in the 30-something years I've been doing this, right? And so if you look back to, let's talk long-term trends. If you look back to the 90s all the way up to pre-Great Recession, there are companies that were serial acquirers. There aren't a lot, and I mean 10, 15 deals a year. And that doesn't exist anymore. In a world where a deal has to go to DC and you can't have, and I'll leave this to Mitch and Mark to address, but you can't have that demonstrative, concrete conversation with the regulator before you announce a deal that says, will we or won't we? And the answer is yes, go ahead and move. And the timeline extends dramatically. Then the other data point that is obvious is you go from the target's asset size in the early 90s being 1 or 2% of the acquirer's size to today, it's more like 20 or 25%. If I'm going to do a deal and I'm going to be on the sidelines for 2 years, right? Not just for the period of time that it took to get approval, but it's, identifying, negotiating, executing, announcing, approval, integration, then it better be relevant to my franchise. It better be one of my top choices. I better really understand what I'm getting into, and therefore it's got to be significant. Well, that becomes circular, because if it's significant, I'm going to be much more selective and take my time to get it done. And if it's significant, my dialogue with the regulators may take longer as well. So that's the first thing. I think buyers are focusing on targets of greater significance. And then the other things are the things that Scott alluded to, but let's dig into the math on one of them, which is we've seen this change in rates. We now have, as opposed to 1998 and before, purchase accounting. So if you think about the 3-year treasury, 3-year treasuries are down 10% in price in the last year. If the average bank is 60% loans and average great bank, I should say, is 60% loans and 30% securities, then the treasuries would be down 10 points, 7% after taxes, maybe the loan's half that if you're lucky. You're talking about, at the end of the day, the after-tax math is you're reducing 8% tangible capital to maybe 3.8% tangible capital. Deals, with some exceptions, are effectively capital hungry. And so in order to announce and execute a deal, you have to be in a position where you understand what the capital impact is. Forget about the metrics on book value per share and earnings per share. There may be a capital raise necessary to put two companies together, and that adds to the unknown when it may be 9 months to a year till when it's approved. And we could talk a lot more, but this isn't a conversation about desire. It's a conversation about getting deals done and limiting uncertainty.
KBW's Scott Anderson agreed that financials weren't the issues holding up transactions at this point.
The math piece of the puzzle is generally solvable. Not perfectly every time, but generally solvable. The regulatory piece of the puzzle, given that it seems to be, at least pre-today, somewhat unknowable and maybe evolvingly knowable, that's the piece of the puzzle that's worrying me and giving us pause as to whether we're going to see that much activity here in the near term.
While it might seem easy to blame regulators for gumming up the process, Mitch Eitel gave credence to that notion and said that many would-be buyers are concerned about obtaining regulatory approval for some deals. It seems that fear has even kept some acquirers on the sidelines.
One of the questions we get all the time from clients is, I really have my eye on X, which is a substantial deal, but I'd like to do Y, right, which might be some smaller deal. And they just say, guys, if I do this smaller deal, am I going to be putting myself on the sideline so I can't really hit my target? Maybe my target's not available right now, but you never know what's going to happen, and I don't want to be sidelined by it. So the length of time it takes to get things done and the concern that you could be put on the sideline for a long time does keep those potential serial acquirers from being active acquirers of anything other than perhaps very small things. And another, then both Scott and David alluded to a phenomenon which I think is a really fundamentally important element of the view of the regulatory environment that people have. there's not just concern about how long it will take. There actually has been a concern about whether an approval can be obtained at all, and your ability to get a sense of that, even if it's small but significant probability of a declination in approval up front, because your ability to dialogue with the regulators is much more limited than it is.
One new development in the regulatory approval space came not too long ago with the approval of U.S. Bancorp's acquisition of MUFG. Mitch later expanded on that issue. The deal was originally announced in September of 2021, and U.S. Bancorp expected that it would close in the first half of 2022. The transaction faced multiple delays as USB waited for regulatory approval, and that approval finally came on October 14th, but there was a list of stipulations associated with it. Mitch outlined what those stipulations require and what they mean for future deal making, particularly large deals. He also noted that some of the requirements gave a little bit of the read-through to the possibility of large regional banks having to hold more long-term debt, or total loss absorbing capital, or TLAC, like some of the GSIBs have to today.
Big bank deals raise all kinds of issues, but one of the particularly unique elements is financial stability and how they impact that. And this blossomed up in the context of the three large transactions that are outstanding now, and MUFG, U.S. Bank, and the two others, around the concept of resolution planning. And there are different issues that are there. One are, these institutions which are not globally systemic institutions and therefore not subject to the higher level of resolution planning related overlay, right? GSIBs are treated quite distinct in the world of resolution planning, where they've all ended up with what are called single point of entry plans, which just means that the holding company goes into reorg and not the operating subsidiaries. They've been required to raise equity-like long-term debt that's intended to facilitate that single point of entry resolution program. And, institutions that are below that category of GSIBs have not been required to do those sorts of things. Now, there isn't anything in this order that says that that's what's going to be required, but there has been some thinking about, pushing what are called large regional banks. You tell me what that means. I'm assuming 250 and above in assets, toward the GSIB model. The now chairman of the FDIC some years ago made comments that were, I think, become quite important, that he was concerned about large regional banks being unresolvable and felt that they need to be subject to something like TLAC, or total loss absorbing capital requirement. Controller Sue made comments saying he thought that the large regional banks needed to be more like GSIBs, in effect, in the context of resolution, because they could be inherently unresolvable because of a variety of factors. One, it's hard to break a big bank apart. Two, where do you sell the pieces to? Everyone's plan said sell them to JP Morgan. It can't be that everyone fails and they all sell everything to JP Morgan. I use them illustratively. It's a small list of buyers, for these large pools of assets. And that, together with, by the way, the simple fundamental problem that there were no personnel in the senior seats at the Fed in particular, but also at the FDIC and the OCC for some period of time to actually make decisions and move some of these deals forward, held the whole process up in the approval. Controller Sue had suggested requiring commitments from the banks to say that whatever we decide, you'll agree to do it. You'll revise your resolution plans and make them more like GSIB plans, and you'll make some open-ended commitment. And no one really liked that. So what has happened is a more generalized approach. The Fed put out a proposal. Controller also has put out some stuff, and the FDIC is considering it today. Basically to ask a lot of questions. So they put a release out that just asks a whole bunch of questions about what people think resolution planning should look for big institutions. But at the same time, they issued at the Fed an order approving the USB deal. there are a couple of commitments in there. The controller, by the way, also required commitments for the bank level approval. And they basically say that 6 months after the deal is done, USB will update its plan to reflect its new structure, which now that we have it's not an every year cycle of resolution planning for institutions like this, they're going to update it. And they'll take steps to meet a higher level of standard when those standards are developed. So USB will bring its resolution plan up to whatever it's required to do in effect. The controller has asked them in the meantime to do the work necessary to demonstrate what would they sell if they had to go through resolution, and how would they do it.
Slower and possibly more complicated approvals for larger deals hasn't been the only regulatory issue troubling some buyers. We've heard that some more normal regulations and the enforcement of those provisions outside of deal making has negatively impacted transactions. We asked Mitch's colleague Mark Minting if he agreed with that assessment, and he did, noting that consumer issues in particular have raised problems in some deals.
Well, it's safe to say that, and this also results from a Biden administration executive order. There's an enhanced focus all over the government on discrimination, and discrimination in lending is a prime focus of the Department of Justice and the bank regulatory agencies at this particular point in time. So, I think the heightened focus on that, the heightened scrutiny on that, can ultimately have an impact on somebody's regulatory standing and rating, and ultimately their ability to get a transaction done. So, it's no great secret that the CFPB is very, very active in this space, as is the DOJ.
He also later noted that it was imperative that banks entering into any deal conduct regulatory due diligence around consumer issues to avoid any pitfalls in the transaction.
Mitch mentioned consumer compliance. I think you have to do a very careful look on the consumer compliance side. Part of that, it's fair lending. I also think, branch closures and post-closing branch network is also an important regulatory focus as well. But I would put consumer compliance up front in today's environment. And I will also say that BSA AML compliance remains very important. We've been dealing with the post-Riggs world since 2006, and there's still a lot of BSA AML challenges and issues out there for people, and I would not take your eye off that ball. Most people are in very good shape on the BSA AML front and the economic sanctions front, but problems in that area can be very serious problems for getting a deal done, and they can also impact your ratings, which will ultimately be dispositive as to whether or not you can or can't do a deal. So I would focus on those issues.
The volatile market environment has created issues with bank M&A as well. And perhaps the biggest issue has come with the recent spike in interest rates. That's changed the math of transactions, in particular because the value of many bonds that banks own have come under severe pressure. And as we've seen rates spiked, unrealized losses have reached very high levels for many banks. The result of which has taken a chunk out of accumulated other comprehensive income, or AOCI, which does not impact earnings, but has driven down tangible book values, and as a result, tangible common equity at many institutions. At the same time, the rate environment has altered merger math because buyers have to mark target portfolios to market. And that's resulted in punitive marks on those same bond portfolios, as well as the loan portfolios of many institutions. And that's led to higher levels of tangible book value dilution and longer earn-back periods associated with transactions. David Sandler said the marks are essentially just math, but can result in substantial hits to capital. However, he noted that the situation is different than if buyers had to take severe credit marks on targets portfolios, like we saw in the Great Recession. In the case of severe credit marks, that would be permanent, and the value of the loans might not recover. In the current environment, though, bonds and loans that require hefty marks likely will be money good. It will just take some time. That means the complication just requires great explanation to the street, David Sandler said. Scott Anderson agreed with that, but noted that more buyers have included provisions in deals where the pricing of the transaction would change if the target's tangible book value falls notably between the announcement and close.
Yeah, that's an interesting one. And for the good of the order, Nate gave us this question in advance. We had to do a little homework on it. And we did our homework, and I knew I had seen it. I didn't realize how prevalent it has become. If you go back 2 or 3 years, it was about a quarter of the deals that were announced that had some provision in there regarding either credit or capital related thresholds. It grew to about 30-something% a year ago. It's about a third plus, about 37% now. So it's important. You see it out there, and it's growing in importance over the course of the last several years.
With all those challenges, it's no wonder we've seen a slowdown in deal activity. And it seems that more shoes are likely to drop next year. According to David Sandler, noted that liquidity pressures are just starting to be felt and will grow, and possibly considerably for some institutions. And he, like others, fully expects credit quality to deteriorate from such pristine levels today. But that doesn't necessarily mean bad things for deal advisors. Right now, it's a little bit unclear whether credit will just normalize, like we've made the case and so have others. And if that is the case, it seems that deal activity will resume in force. If not, Sandler seemed optimistic that advisors will get work another way, working on capital raises for banks.
I think we got some pain to come there. If you look at this quarter of earnings announcements thus far, the top 200 public banks, I think about 14 had reported as of last night. And what you saw was deposit costs on the median up 31 basis points with margin up 18 basis points. That's not sustainable. There are no market deterioration in credit across those who've reported yet, although there may have been some larger provisioning on a one-off basis. And in the meantime, 2-year treasuries yield almost 4.5. Brokered CDs have now gone from 50 basis points behind treasuries to even with treasuries. Oh, and by the way, treasuries are state tax exempt, which means that in order for a CD to have the same after-tax impact as treasuries, it has to yield, depending on your state, closer to 5 than 4.5. Deposits are flowing out, loans are up. We haven't seen the impact of that yet. Liquidity is going to drive some level of credit erosion over the next 6 months. So I don't think we've seen even close to stability in rates yet. And unlike the environment of credit deterioration that pretty much everybody who's been investing in this market globally has experienced, which is a credit blip followed by a liquidity tightening followed by a credit crisis, this is actually the other way around. We're seeing the need to increase rates and tighten liquidity that is demonstrably going to lead to some level of erosion in credit. So I don't think we have that stability yet. I can tell you that next year is going to be a busy year. One of my mentors used to say, I know exactly where the market's going. It's going up, either in yield or in price. Next year is either going to have the kind of stability that we're talking about, in which case we'll see a big ramp up in the execution on the deals that are being discussed, or we'll see a big round of capital raising. But it's going to be a very active year in 2023.